Tonight, after a massive interest rate rise last month, another looks like it's just weeks away. But as homeowners struggle to find the extra cash for their mortgages, cheaper options are starting to emerge, and it's set to cost the big four banks big time. After going full beast mode with back-to-back supersized rate rises, Reserve Bank boss Philip Lowe seems to have developed a taste for it.
Governor Lowe was quite explicit in warning Australians to expect further increases in interest rates.
Markets are forecasting that the cash rate will hit 4% by the end of this year. Now that's very aggressive, especially considering we've only got 6 more RBA meetings.
After previously predicting no rate rises till 2024, Lowe apologised for hitting homeowners with a sucker punch.
The way the target ended in late 2020 was disorderly and it did cause some reputational damage to the RBA.
But it's bad news for big banks too. A decade of record low interest rates allowed the big four to tighten their grip on the mortgage market, offering ultra-cheap fixed-rate loans that smaller lenders couldn't match. Now, that equation's starting to change.
And some of the cheapest loans are coming from lenders you've probably never heard of before. And a lot of those don't have bricks and mortar, they're based online.
Digital settlement platform PEXA has seen a 20% spike in refinancing deals. And while the big four banks account for 3/4 of all home loans, more and more customers are jumping ship. Smaller lenders responsible for 2/3 of the growth in the mortgage market. So if shopping around could help you ease the repayment squeeze, what's the hold-up?
These are great rates and they are headline rates. The question that you need to ask yourself is, are they going to stick at that low rate for a while?
Well, ABC Business journo Daniel Ziffer joins us now. And Dan, if people haven't refinanced yet, should they be thinking about it or should they be racing for the phone? Where are we at?
Well, look, there's certainly no harm in doing it. The first thing people should do is essentially go to the institution where they have their loan and see what the rate is for getting a new loan. And if it's higher than the one you're paying at the moment, then you're essentially paying what's called a loyalty premium, which is dumb money, essentially a penalty for being a loyal customer, and they're giving a better deal to people who just walk in the front door. So people can refinance. It really comes down to how much time they want to spend on it for the potential money that they could save.
Oh, OK, well, that all sounds fairly straightforward. When did you sort all that out, Dan?
I have, for my sins, literally written a book about banking and talk about this all the time, but still haven't got around to refinancing a loan that I have. Although, now that I've been shamed on national television, maybe I will. Look, it is a bit of a pain. You've got to get together your tax information, your spouse's tax information, and lots of other details. And one of the reasons that people don't do it is that it is difficult. Now, things are getting easier through a thing called open banking, where some of that data is going to be shared between the banks, but it still does require you to do it because essentially you've got to take out a loan again. You've got to close off the one you've got and go for a new one. So you've got to go through that application process again. It's painful. You might save some money.
Well, what about the risks of going with a smaller lender? Is there anything that people should look out for there?
Look, there certainly may be different. You might be able to get a better rate. And the reason is that money's a commodity and banks have to go out and buy it so they can sell it to you as a loan. Now, while we've had really low global interest rates, big banks have had a massive advantage to get really low rates. As the rates go up, that advantage is kind of diminished, and so the gap has changed. With a smaller lender, there might not be a branch convenient to you. There might not be any branch at all. They might just exist online. So the service might be different, but it's certainly worth investigating if you're looking to save some money on what might be a really substantial mortgage.
Does this mean it's a good time to start an online mortgage company called Trusty Tom's Easy Mortgages.biz?
That is definitely a good thing you should do on your MySpace or any other trusted platform that you have available to you.
How old are you, Daniel?
Come on, mate, you had a .biz website address.
Still a thriving URL, I'll have you know.
Look, Dan, you did mention that this is quite difficult. It can be quite convoluted and complicated. So spell it out for us. I'm sitting at home. I'm thinking about refinancing. Where do I start? Where do I go first?
So look at the institution that you're with and find out the rate that they're giving to new people. If you want to contact them after that and give them a piece of your mind, you'll probably get a better deal there just by starting. Beyond that, look at different institutions or use someone like a mortgage broker who'll give you an idea of the kind of money you could save if you're looking to refinance your loan. Like I said, it is a hassle. You're going to have to do some work, but you might save a quite substantial amount of money over a long period of time.
Dan, thank you very much for your time.